Well, welcome back. It is time for the Word on Wall Street. Top investors watching your money. Joining me right now is ERShares CEO Joel Schulman. Also with me is Rebecca Walser. Joel, thanks very much for joining the conversation this morning. I want to take a look at futures with you and take a look at this week. This is like the last final big week for markets in Washington because many are leaving for the holidays on Thursday. Look at markets up across the board again this morning. Dow Industrials up 50, NASDAQ up 15, and interest rates this morning are also lower. The 10-year Treasury right now is down 5 basis points, sitting at a level of 4.1%. Nice number after we got all the way up close to 5% a couple of weeks ago. Federal Reserve, of course, kicking off its last policy meeting of the year today. And we will find tomorrow the Fed likely say that they took another pause in the rate hike string. We're also awaiting the November CPI this morning out at 8:30 a.m. Eastern. We're expecting unchanged reading month over month, but we are going to get a gain. 3.1% is what the economists expect year over year. What are your expectations, and how would you assess the current thinking on the Fed?
Well, I think that if we do come in flat again, or even possibly negative, it's going to be very bullish for the markets. I mean, it's 3.1% annualized rate right now. It's half of what it was a year ago, and it's down 2/3 from where it was about a year and a half ago. So the markets clearly are in an upward trajectory with declining inflation. I think this is going to be very bullish for the market. This is going to be a big catalyst today at 8:30.
Yeah, so what about the Fed next year? Do they cut, do you think? Where are you on that debate?
They're going to cut this. So the narrative now is actually a fun narrative. It's going from when is the Fed going to stop raising rates to when are they going to start cutting, and how much are they going to cut, how many times are they going to cut, and when is it going to start? If we have a negative number today, and that's possible if shelter, which has been running about 0.6% increase month over month, about 7+% year over year. If in last month it dropped from 0.6 to 0.3, if it continues to drop, and eventually, this real estate, the shelter number is going to start to drop, and it's 30 to 40% of the overall total, then we could possibly see negative inflation rate number posted today, possibly could be negative 0.1 or so. And if that's the case, we're going to have a very strong day today. The rest of this week, a strong Christmas rally. It's going to continue through January. So today's number is very important. Look to shelter. We already know energy costs are down. Some food prices are up. Some food prices are down. Sugar's down quite a bit. Beef is down quite a bit. Cotton, coffee are up. So we'll see. It's going to be an interesting number today, 8:30. I'm hoping for a flat to negative number. And if so, we're going to have a big week, a big month, big year-end finish, and a good January.
Yeah, even as the economy is slowing, Rebecca, look at all of these layoffs. I mean, I keep saying if we're going to see the Fed start to cut rates aggressively in 2024, I have to believe that is in response to a very slow showing or a recession in the economy. Look at the layoffs. Toy maker Hasbro, the latest, cutting nearly 20% of its workforce. They're talking about weak sales for toys and games. That's persisting into the holiday shopping season. The Monopoly producer will cut about 1,100 jobs on top of the 800 layoffs from earlier this year. Rebecca, your reaction?
Yeah, Maria, they had expected only a 3 to 5% decline in sales for the year. They came out in October and increased that to 15%. And as you said, CEO Chris Cox has basically said the market headwinds we anticipated have proven to be stronger and more persistent than planned. So this is just a toy maker. They saw pandemic level highs of sales because people were basically at home and had to, keep their kids busy with the online school that didn't go so well. And so they saw this massive increase during the pandemic. And since then, since the stimulus has run out, since credit cards are getting maxed, since people are starting to really feel like they have no savings left, it's going to affect the holiday season. And I hope Joel's right that we get a flat or even negative, which would spur the markets and maybe give us, a really still strong year-end rally. However, this is just indicative, Maria, that the retail consumer and consumer confidence and spending is definitely going to be impacted. And you're right, we shouldn't expect the Fed to really pivot and start cutting until we start to see this really impact the labor market. And so far, that's been the stalwart, is allowed, Jerome Powell to continue to raise so aggressively. And then potentially that might allow him to hold. But we'll see. This is an indication. The Fed does not want us to go into stagflation and deflation. And that is the risk, that they did too much too fast. And so we're going to have to see where this plays out.
Are you surprised that we haven't seen a bigger impact from 11 rate hikes in a short period of time, a year and a few months?
This is unbelievable. I mean, the economy is so so robust that a Federal Reserve central bank policy, they could do something so aggressive, so unprecedented, except for maybe in the 80s with Volcker. It is just unbelievable, Maria. We have a strong global economy, but yet the reckoning must come at some point. You just cannot print $20 trillion at pandemic level timeframes and then expect that the globe can just absorb it without repercussions.
Joel, what do you think? Are you surprised at the length it's taken for a real slowdown to occur, given look, you look at some of the interest rate sensitive groups like housing, you've seen a serious recession.
Right. So we have to remember that the unemployment's 3.7%. I mean, it's been as low as 3.4% much of the year. It was 3.8. That unemployment's not going anywhere. We've got 80 million baby boomers who have been retiring at 4.3 million per year. Unemployment is only about 5.8 million. So it's a very significant amount of people on this. In fact, we've probably got 10 to 15 million baby boomers who are eligible to retire that haven't done so. So we're going to continue to have a very low unemployment for the foreseeable future. That's keeping our economy resilient. Many of the layoffs, now the example of the toy company is a little different, but many of the tech layoffs have been overseas with foreign workers, H-1B workers, either work in the U.S. or foreign or overseas workers. And so it hasn't really hit. I look for tech, consumer discretionary a little bit, but mostly tech, healthcare, and communication services that are going to score big. If we have a good inflation number today, it's going to be those areas, and it's going to move down in market cap. We're going to go from the mega caps, which are already starting to show signs of weakening, to the smaller large caps and the mid caps and the small caps. Those are going to be the big winners. Go out long in duration for the stocks.
Well, that group has not moved the way some of the larger caps have.